I'm Ajit Jain. Today, I'm going to discuss the basics of international taxation. What is international taxation? What is the applicability when it comes to the Indian tax laws? Now, when it comes to the international taxation, it is not the right terminology because there is no global one law for taxing, so for applicability of taxation internationally. Every country has their own laws, tax laws, and then there are the tax treaties between the countries to drive the overall taxability when it comes to the cross-border arrangements. Now, the right terminology should be it is a cross-border taxation rather than international taxation. But as I said, that it is a terminology. Both the terms are right, but practically it is a cross to just to make understand properly. It is a cross-border taxation between the countries, and the effect is at the level of local tax laws, and also the tax treaties have the different provisions where the person can take benefits of the tax treaty of the tax rates and the provisions between two countries. Now let's start with the basic provisions, basis of charge. When it comes to the Indian tax law, what is the basis of taxability, basis of charge of income tax? So I'm not going to discuss the residential status, but there are three categories of residential status in terms of applicability, in terms of overall taxability: resident and ordinary resident, resident but not ordinary resident, and non-resident. Mostly the last two categories, which is resident but non-ordinary resident and non-resident, the applicability in most cases is same for resident and non-resident, and non-resident are at par. But when it comes to the resident and ordinary resident, the applicability is different. Now coming on to the taxability, India follows residential based. There are two different type of taxation: residential based and source based. India follows the residential based taxation. So any income which is accrued and arise in India is taxable in India. Whatever, if whether it is a resident or ordinary resident, resident but non-ordinary resident, non-resident, if any income accrued or arise in India, taxable in India. Suppose I have a flat or I have a home in India, I'm an NRI, and I'm getting a rent income, it will be taxable in India. Or I'm getting an interest on FD, it will be taxable in India because of the residential rule, and because of the rule that any income accrue or arise in India or source in India is taxable in India. Now any income which is received in India is also taxable in India, whether it is resident or ordinary resident, resident but non-ordinary resident, and non-resident. This is the Indian income where the source is in India. Now foreign income, the accrued any income accrued outside India but deemed to accrue in India by virtue of Section 9 is taxable in India. Now we'll discuss later on what is deemed to accrue or rise in India by virtue of Section 9, but any income, foreign income which is accrued outside India but deemed to accrued in India will be taxable in India. Now any income which is accrued outside India, first received in India, is also taxable in India. Now any other income which is accrued outside India and received outside India is taxable in the hands of resident and ordinary resident. As I mentioned, India follows residential based taxation. Any income earned by a resident or ordinary resident outside India is taxable, always taxable in India. And any income which is earned outside India by a resident or non-resident or non-resident is not taxable in India. If I am a non-resident, I am earning income outside India from a salary, from any project or any other income which is accrued outside India and received outside India, is not taxable in India, provided you have to be a resident but not non-resident. We'll discuss what is deemed to accrue or rise in India, but the fundamental here is that for any person who is a resident in India, any income accrued arise in India or outside India is taxable in India. For a non-resident, any income which is accrued in India, received in India is taxable in India. For a non-resident, any income which is accrued outside India, received outside India is not taxable in India. That is the fundamental is where is your residential status, and where is the source of income, and where the income is actually arising. Based on the same, your income is taxable in India. Now, moving forward to the basic, this is the basic chargeable mechanism. We'll discuss more about the residence status. We'll discuss about what is the income deemed to arise in India. But we discuss the basic concept of taxability in India is that any income which is accrued or arise in India, for whether it is a resident person or non-resident, is taxable in India. Any income which is accrued and arise outside India and received outside India will not be taxable for a non-resident non-resident. And if any income is accrued outside India, received outside India, for a resident, still taxable in India, because for resident all the global income is taxable in India. Now, coming on to the international taxation, what is the international tax is? Why international tax? Why we need such a tax treaties? Why we need the tax system internationally? Last 2 decades, there has been a significant increase in the cross-border taxation, increase in technologies. The world has become a global village. Trade have increased. The sharing of resources, technology, manpower, sharing of intangibles, and countries across the globes and tax authorities across the globes are very much concerned about the taxable revenue. Why any country is concerned about the taxable revenue? Because the revenue is the key source of income for any government, and all fiscal deficit or fiscal whatever the profitability of the government is depend upon the revenue collection. If any country is not able to collect the fair share of taxation, it is really challenging for that country to come over from the fiscal deficit to run the country, because every country need funds for infrastructure, for running the country overall. So tax revenue is the key source, and no government, no tax authorities will accept the situation where it is not collecting the fair share of taxation. And people are shifting profits from one country to another country where the tax rate is low, shifting of profit, or doing tax avoidance or tax evasion. There we need a need for an international taxation, that we need have a agreement or arrangement between the countries in terms of overall taxability. If there is a cross-border taxation, we need provisions in the local laws that what would be the taxability, where is the overall impact. And then it's not about only imposing the taxation. It's all about giving the relax to the taxpayer when it comes to double taxation, because it might happen that I am paying tax in other country for my income as a resident, and I am also paying tax in India as well. So there are provisions in the tax treaty which gives reliefs to the taxpayer. Now, as I mentioned that technology, internet, change in resources, all those digital marketing, mergers and acquisitions, the world has become global village, and international tax is playing a significant role. And importantly, last 5 years is very significant because of this digital world, things are changing. A decade ago, a concept of permanent establishment, kind of a fixed place of business, separate entities, their role is different. Now last couple of years, things have changed. In today's time, it's very difficult to analyze where is the significant economic activities are performed, where are the key functions are performed, which entities are liable to pay tax in which countries, because things are done digitally. Who knows who is the owner of the intangibles, who is contributing to that intangible, and who is the decision maker. So it's very difficult to find out the returns in terms of the overall value chain, and it's very difficult to find out what is the overall taxable revenue. So the government and the OECD, the Organization of Economic Cooperation Development, with the involvement of the G20 nations is doing a significant efforts in coming out some guidance, on the way how the international tax system can be revamped in light of the old digital activities are being performed. So having said that, the scenario of international tax is going to change, and the tax avoidance and tax evasion is costing a way more, huge amount of charge, or huge amount of penalties, huge amount of taxable revenue to the government, and no government wants to sacrifice in terms of the fair taxable revenue. So these things are going up, and the overall scenario is changing in terms of the international taxation, in terms of digital world, in terms of where the significant activities are performed, in terms of where the returns are generated. Now moving on to the as we have already discussed, why international taxation. We already discussed that there has find out where is the economic activity performed, where the sourcing capital, where is the cheapest. So people are shifting their resources, people are shifting their capital, people are moving ahead with where the benefit is. So there is no issue in shifting the resource, shifting the capital, as long as there is no tax avoidance or tax evasion within the framework of the law. But the point here is, in many instances it is observed that shell companies are open at in the tax havens, and they don't have any significant activity, but profit are parked in those countries or though in those entities, and they are paying low tax in spite of the profit is there, and profit is shifted from the high tax jurisdiction country to low tax or tax havens. To curb all this, to make to avoid all this, the OECD has come up with the base erosion and profit shifting action plans, that those activities should be stopped, and it is a kind of a guidance which is issued, but ultimately it should be replicated in the local tax laws between the tax treaties. So there is a need of international taxation, there is a need of more revolutionary framework for the overall system, because it is the demand that the current framework of the international tax law does not work, and it will affect the overall tax revenues of the countries across the globe. What is double taxation? So I mentioned about what is the international tax, why there's a need of international taxation. But as I mentioned, there's a need of international taxation to avoid shifting or profit, but there are other objectives as well which give relief to the taxpayer, like avoidance of the double taxation. And that's where the treaties between two countries plays a very important role, because if I am paying a tax in one country on my global income, then the same tax is also, I need to pay tax in other country as well. So there is a double taxation. So but what is a double taxation? Double taxation is a taxation of principal referring to income tax that are paid twice on the same source of earned income. So my source of income is outside India, and as a resident I am paying tax in India and outside India as well. So there are two types of double taxation: juridical double taxation and the economic double taxation. Now, double taxation has detrimental effect on the movement of capital, technology, because the overall revenue overall taxable revenue also impacted, and its overall impact on the overall, on the individual income or the income of the company. So it has overall larger impact of the economy as well, because if there is a double taxation on the companies, then they won't be able to justify their activities or their profitabilities, impact overall their business. Accordingly, the double taxation avoidance agreement, when properly applied, remove the obstacle of double taxation, thereby promoting the development and flow of international trade and investment. Now as we discussed, there are two kinds of double taxation: juridical double taxation and economic double taxation. Now coming on to the juridical double taxation. Juridical double taxation is the imposition of income tax in two or more states on the same taxpayer in respect of their income. Now, imposition of income tax in two or more states. States means two or more countries. So, if there's a one income generated from one place of sources, it is taxable in the two different jurisdictions. That is a juridical double taxation. It arises in the following circumstances where the resident of one country derives income from the source from another country. So, where the resident of one country derive income from the source of another country, and both countries' domestic tax legislation would tax that income. I, as a resident in India, if I derive income from United States of America, both the tax laws in India and tax laws of US imposing tax on that income. That is a juridical double taxation, where each country consider the taxpayer to be resident in that country under domestic tax laws. Now, each country consider taxpayer to be resident in country domestic tax law. That's why they are, imposing the taxability. That is a juridical double taxation, taxability of same income in a two different jurisdiction. Now, let's say for example, what is the double taxation? In turn, let's take example. United States of America, resident of which is a resident country. India is a source country. Now, provide services to his client in India. So, one company provides services to his clients in India, which is a US based company. India receives fee in the Indian bank account. Okay, so India is a source country, receives fee in the Indian bank account, and it provides services to his clients in India. United States of America, which is a resident country, is effective rate of taxation is 12.5%. India is a source country where the revenue is generated, is again taxed at a 10%. So overall, there is a tax of 22.5% double taxation. US is a resident country where the person is there in the resident person. The income is generated in India because it is in the bank account in India, and it is taxable because of the residency. It is taxable in US, and because of the resident source nature, it is taxable in India because it is accruing or arise in India. So it is taxable in India. So there is a double taxation. Now 22.5% is a double tax. This is a juridical double taxation, putting 10 and 12.5 together, 22.5. Coming on to the economic double taxation. Inclusion by more than one state's tax administration of the same income in the tax base when the income is hence of a different taxpayer. Typically arises when one state applied its transfer pricing rule. Some DTAA mitigate this by way of correlative adjustment. So let's understand one. Inclusion by more than one state tax administration of the same income in the tax base when the income is the hands of a different taxpayer. So two different taxpayer taxable in a two different state is the economic double taxation, and mainly applies in a transfer pricing rules. There are tax treaty to mitigate this kind of economic double taxation by doing the correlative adjustment in the tax treaty. But this is not more common. The common in the juridical double taxation, which equally applies to resident and companies. Economic double taxation is not that common. Now let's talking about the avoiding double taxation. How one can avoid the double taxation. International double taxation has an adverse impact on the trade and services and movement of the capital and people. Taxation of the same income by two or more countries would constitute a prohibitive burden on the taxpayer. Now, effect of double taxation can be eliminated by two methods: unilateral relief and bilateral relief. We'll discuss unilateral relief and bilateral relief in our next video. So today's video is all about what is international taxation, why international taxation, what is the objective of international taxation, what is double taxation, what are the different kind of double taxation, and now we are talking about how to avoid the double taxation. We'll talk about more in our next video what is the unilateral relief and what is the bilateral relief when it comes to the avoidance of the double taxation. So that's all for today. I will come back with the next video in terms of how you can avoid the double taxation. I will speak more on the juridical and economic double taxation. Along with that, as I spoken, I will also talk about what is the income deemed to accrue arise in India and what is the meaning. I will take some examples. So far, I hope you like this video, and you please, if you have any comments, give your comments, and we'll stay in touch, and we'll talk more about the international taxation and the changing world of international taxation. Thank you.